Hi, everyone. It's a pleasure to be here. I'm excited about this conversation. I'm going to say a few controversial things along the way, and so I'm eager to provoke you and hear you react. So I want to talk about FinTech for good. I want to begin by talking about the good stuff that households should be doing in the FinTech sector for themselves. And this would go for anyone, low income or high income, doesn't matter. They should have some money market savings. They shouldn't be using credit as their source of emergency liquidity. They should have low-cost, highly diversified index funds for retirement savings. There's lots of low-fee banking services out there, or even no-fee banking services. They should be using them. They should be operating in environments where fees are unshrouded, and they should be getting their advice from fiduciaries. Now, the market I've just described, or the marketplaces I've just described, are not especially profitable. These are markets that are pretty much commodified. These are markets that are often loss leader markets. These are markets that are sort of unappealing. This is sort of what Josh hinted at when he opened up this morning and talked about FinTech as an environment where there's not a lot of low-hanging fruit in terms of profit opportunities. So these are eat your vegetables financial services. So how would a household benefit from banking services? Well, they can go and get a no-fee account with free ATM privileges. That's now widely available. Now, not everyone's doing it, but it's out there in the marketplace. They could keep a rainy day savings account with $2,000 in it and get some interest on that and avoid carrying credit card debt. Let's think about the economics of this customer, especially if they're a customer with low income, a low-income family. They're going to cost the provider about $100 a year, depending upon how automated the relationship is. And they're going to generate revenues for this provider of about $20 per year. So this household with low income, and this is, again, Josh's point, this is not a profit center for this provider. Now, the way that providers make money with customers like this, and the reason that they're not driving them all away, is that they're interested in cross-selling. So they might cross-sell mortgage products, credit cards, something else. There might be some fees that are built for people to stumble into, but it's that other stuff that's out there that the financial provider is hoping people are going to stumble into that makes this business model not crazy for the financial service company. Now, how do you succeed in business in this marketplace? And this is not my advice slide for you. This is what is happening in the world. I'm describing the world we live in. This is the economic analysis that is sadly the reality of the status quo competitive market. There's a lot of high-fee stock portfolios out there, active management, lots of trading commissions. There's lots of banking services with shrouded high fees. There's lots of failure to see competition actually drive down pricing. So someone gets a mortgage, they go to their own bank, they get a quote from their own bank, they take out that mortgage, and it's 100 bips above the competitive interest rate in that marketplace, or worse. There's lots of non-fiduciaries, including brokers with distorted incentives, commissions, misaligned relationships, bad advice, lots of unneeded profits in a marketplace where there's a lot of people running around at cost, creating distorted opportunities for consumers and encouraging them to buy the wrong products. Now, I happen to be an expert in getting people to do things that they may want to do or they may not want to do, and that's what behavioral economics often is about. Now, hopefully, I'm trying to get them to do things that are good for them, but we know that it's also easy to get people to do things that are bad for them. And this industry is spending a lot of resources on that latter category. Now, this credit, another kind of interesting category in this marketplace, there's a lot of high-cost credit being marketed, sometimes being marketed in the FinTech space. Now, if I were defending all this high-cost credit, I would say, maybe it's crowding out even higher cost credit. So the argument that is really legitimate. I mean, it's not one I want to endorse, but it's one that I can't rule out, is we're making payday loans or things that are like payday loans, which are good for our customers because these loans are less toxic than using a pawn shop or whatever other crazy margin of credit there is out there for the borrower. It's a lot like this quote from me. We're selling Doritos, which are good for you because they have less sugar per gram than Oreos. Now, probably that's true, but I don't feel great about all of these high-cost credit products that are getting offered at a lower rate than the alternative, but still at a sky-high rate, which I would never recommend that anyone that I know actually go to as a borrower. So, what I want to ask is, do we need to sell financial junk food to make a profit? Now, that said, I am not above a bag of Doritos or a McDonald's hamburger or Oreos, all foods that I routinely eat happily. But we have to ask ourselves, what are we trying to achieve? Now, to make matters worse, and I don't want to just pile on the bad news, let's think a bit about wealth formation, which is an even harder category than some of the categories I've mentioned already. Wealth formation for low-income households is definitely not a profit center. The service and record-keeping costs for an account per year is about $30, and I'm being kind of conservative there. It's probably more than that. If you charge 50 basis points, BPS, basis points of fees on a $1,000 balance, so you're thinking about a household that's just beginning to form their wealth, you're going to get $5 a year in fees off of that account. Your acquisition cost for bringing that account in might be $100 or $200 or more dollars, and you can see the economics of this just doesn't make any sense. So trying to bring in a household with low income that's just beginning to form a portfolio is not a profitable proposition. And the real kicker is there's Vanguard out there. Vanguard on a $1,000 account is going to charge 15 bips. That's $1.50 a year. So you have to ask yourself, what am I doing in this market if I've got Vanguard out there providing an alternative, which is essentially a huge loss leader for them. I'm not sure Vanguard ever intends to make this money back. It's essentially a cross-subsidy from their high net worth customers to their low net worth customers in the form of low fees for everyone, especially low fees for the low-income households. So here's the competitive environment in FinTech, or in tech in general. Your competitors are shrouding their own fees. So you look expensive because you're transparent, and your competitors look cheap because they've got it all hidden, and they've got customers stumbling into the fees left and right. Your competitors are stealing your profitable customers. So finally, that customer who builds up the $100,000 or $200,000 balance is going to rush out of your system into someone else's system where they're going to get the good pricing. They're going to get maybe the 0 BIP pricing or something akin to that. Customers with low levels of financial literacy often don't want what is good for them in the first place. So they come to you asking for the wrong product. And you either give it to them and you feel bad, or you don't give it to them and you lose them as a customer. So they want to buy gold for their retirement portfolio or individual stock or whatever it is, and you want to sell them an index fund. Not a great opportunity for you. Now, as you educate your customers, educating them actually makes them less profitable. I like to call this the curse of education, because if you educate them, you basically have taught them that they should want commodity products at low fees, and commodity products at low fees are exactly what's not going to make a FinTech company profitable. So there's so many barriers to creating profitable opportunities in this space. So when we think about FinTech for good, we're looking for that overlap between, well, market return for capital. Obviously, that's a constraint, and Susan emphasized that. We've got to be about actually creating businesses that make sense economically for the capital that's flowing into those businesses. This is not a charitable activity, but also products that make low-income families better off, and we're hoping to find this overlap, but it's thin. I know how to generate market return for investors in the technology space. I know how to do this big time. That's been my focus as a researcher, primarily. This overlap space is a small space that we need to target. And it may be like this. I mean, it's not entirely obvious that the overlap even exists. I don't think it's this bad, but I have to be honest. There's a lot of ways in which this is sort of the space that we see in many different domains. And again, it's Josh's point about a lot of the rents have been extracted from this space, and there's not a lot of low-hanging fruit. But I think we can find this overlap. So here's the impossible intersection that I want you to think about. So we want market returns for financial capital. We're not going to tell investors it's a charity, most of the time at least. There's not going to be a lot of capital that's going to come in for social impact. Most capital wants a return, market return. We want unshrouded, transparent fees. We want to basically act in the best interest of our customers. So we want to be fiduciaries. We want to provide advice that is commission-free, that is not distorted, that is in the best interest of the people that we're serving. We'd like to have best-in-class pricing. I'm going to challenge that in a second. And we want stuff that's good for families. Now, the best-in-class pricing is a problem because once we put all of these 5 elements into the picture, I believe there really is almost no case of overlap, of intersection for all 5 categories. You want all 5 categories to intersect? That's a big ask. That's a hard ask. Now, one of the big barriers here is best-in-class pricing. And it's somewhat illusory. It's kind of it's out there, but it's misleading. It's misleading because it's created by all of these cross-subsidies. So when a bank offers a free checking account and essentially a great deal that would lose the bank money, often the bank is hoping that that customer is going to make the mistake of getting into some credit card debt, of ending up with a 19% credit card balance that they carry from month to month, of going and getting a mortgage that's 100 bips more than the competitive price, of bumping into overdraft fees and everything else. And so what looks like best-in-class pricing, a loss-leading checking account for a low-balance family, or a family that's going to carry low balances, is actually not really such a true deal once you take into account all the ways the person is intended to trip into these mistakes and these higher fees. So here's the plausible intersection that we're trying to achieve that I hope we're all working on together. A market return for financial capital, unshrouded, transparent fees, a fiduciary value system where we do act in the best interest of our clients, thin margins. So I'm giving up on best-in-class pricing because best-in-class pricing is produced by other firms offering prices that are really illusory and built to be seemingly great, but in practice much more costly for the customer when they trip into the fees. So I'm going to ask for thin margins, not best-in-class pricing. And then, critically, a long-term multi-product relationship with a firm that will place the customer's financial well-being above all else, stuff that is good for families. And here's where there's a lot of kind of the secret sauce that's going to, I think, take FinTech to the next level. So we can get the overlap here. So why does it work? Well, first of all, our financial decisions are spectacularly intertwined. When you make a decision in one domain of your financial life, it should be linked to all the other domains of your financial life. You don't want to have 5 IRA rollovers at 5 different firms. You want to have them at one firm. You want to integrate the asset management decision. You want to think holistically about things like life insurance and annuitization and not have them at the same time. Every single thing you do, liquidity management, asset management, credit, it's all interrelated. And it makes sense that it should all be at a single firm under a single umbrella. Now that has enormous advantages, not only as a decision maker, but also because these multi-product relationships lower acquisition costs per relationship. Now you're acquiring one customer who has 8 accounts with you. 8 accounts because they've got a mortgage, and they've got life insurance, and they've got car insurance, and they've got homeowners insurance, and they've got a checking account. They've got it all under one single umbrella. And so your acquisition costs just get a lot lower per account relationship. These multi-product relationships make customers much more sticky. If someone is with you in every single aspect of their life, it's much harder for them to walk away. And so now you've got a captive audience, hopefully for good, not for evil, but you've got a very captive audience. And the typical firm is very worried about losing that customer who can walk away very readily when someone else offers them a better price. Much less likely here, much less likely to be vulnerable to business stealing. The reputational focus aligns the interests of firms and customers. If the firm says, my identity is doing what's best for you, now we've got a different kind of relationship that's not adversarial, but is much more of a teamwork relationship that's going to create that long-term commitment, that long-term loyalty. So reputation retains customers. And finally, most financial products and advice can be simplified, commodified, and automated. These don't need to be complicated, arcane interactions. They can be simplified. They can be generalized. They can be, in most cases, automated with very little human touch. And that's where the tech is going to come in and make all of this feasible. So I think we've got a path forward. I'm a little surprised that there's not more entry into this particular space. There's lots of entry into individual parts of the market, but no entry into the kind of supermarket of financial services that unifies all of this into a single relationship. So here's an example of what a firm like this could do. And this is what firms are not doing today. But this is what a firm that's acting in the interest of employees could do. So this is a program for eliminating credit card debt. Rather than pushing debt, which is the typical way of making money in the financial services business, we're going to eliminate debt. And this is an idea that James Choi and other collaborators, John Bashairs, Bridget Madrian, Steve Zeldis, have been working on. So proposal, consolidate and restructure credit card debt using a new line of credit originated at a low interest rate. For example, 9% rather than 19%. Let's take all that credit card debt. Let's lump it into a single loan. It's a 9% loan. You'll see why it can be 9% in a second. We're going to get that household to switch from using credit card to using debit card. And we're going to have them essentially commit to this using their credit report for verification. This is a new revenue stream for the bank because the debit cards tend to offer higher revenue per transaction to banks. So this is another way of building this into an economically viable proposal. We gradually lower the credit limit on the line of credit, converging to 0 in about 1 to 2 years. So we're just collapsing that credit line so that what was $8,000 of credit card debt 2 years later is $0 of debt. This can be automated. We can pay down the credit line with regular transfers from the checking account. And so there can be, again, very little kind of active engagement here as this automatically collapses down to 0. Of course, there'll be the occasional financial crisis, and people will need to occasionally temporarily freeze the pay down when they are in an emergency. And that's the kind of flexibility you've got to build into these systems or it's going to break. And then where it gets particularly lovely for me is when we switch from the debt paydown path to the rainy day savings account accumulation path. So as they're making these payments and slowly paying off their debt, eventually we reach the point where the $100 a month keeps coming and now it's building up a rainy day fund. And that rainy day fund is also automatically accumulating. And we end up, after maybe 3 or 4 years, not 1 or 2, not only eliminating the credit card debt, which was toxic for these households, but building up a rainy day buffer of a few $1,000s that enables them to weather the next financial storm without going to high-cost credit. Now the household has a liquid cash buffer on which they're earning interest, and so when they next need to go to get liquidity, they don't need to pay 19% for it on a credit card. They pay essentially 2% for it because they're no longer earning interest on their own money market account and instead just drawing down that account and not borrowing off a credit card. This good bank can do this for tens of millions of American households and get them out of the credit card debt that more than half of American households are currently carrying. Okay, the good news and the bad news. Well, the bad news is that consumers without debt are less profitable. So debt is a great way for banks to make money. We're going to give up that opportunity. We're going to give up that particular channel for driving profits in the banking sector with this bank. But customers who see that you've put their interests ahead of your own will be more loyal. The benefit is you're going to retain these customers because they see you as essentially acting in their best interest. They'll expand their scope of business with you, enabling all the cross-selling that's going to make them profitable. And they will tend to be very sticky, preventing competitors from engaging in the business dealing that essentially will prevent you from holding on to these profitable customers. Now they will stay with you. Eventually, your customers will have enough wealth, including all of their rollovers from their 401k plans. They're going to bring those rollovers to you. So you'll staunch your losses in the asset management domain. You won't have $1,000 in their retirement account. You'll have $10, $20, $30, $40, $100,000 in their retirement account. And now you can actually make money in that domain. In the meantime, you're selling them life insurance, health insurance, car insurance, banking services, mortgages, HELOCs. There's a whole ecosystem of relationships that jointly, with thin margins, makes this a profitable relationship. So you can survive essentially selling things to them almost at cost and not losing their business when you build this large ecosystem. OK, so let me summarize, and then I'm going to pass the baton. So serving households with low income is hard or impossible if you're trying to achieve the five-way intersection that I posed earlier. What was the five-way intersection? Market return for financial capital, unshrouded transparent fees, fiduciary values, best-in-class pricing, which means loss leader pricing, because this industry is full of loss leader pricing everywhere you go. You can't have loss leader pricing and get market returns. So we're going to have to give that up. And finally, stuff that is good for families. The path that I think we can move forward on is multi-product financial firms that build reputations and have loyal customers by serving as fiduciaries, no commissions or no distortionary commissions, automating advice, and accepting thin margins. Thank you.